Hello, everyone. My name is Wei Wang, Associate Professor of Accounting at Temple University. Today, it's a privilege to present our paper, Walking the Walk, Bank ESG Disclosures and Home Mortgage Lending, co-authored with my colleague at Temple University, Dr. Sudipta Basu, Justin Vincenza from the US SEC, and Xiaoyu Zhu from Lingnan College of Sun Yat-sen University in China. Owning a home is one of the most powerful ways to build wealth and achieve social mobility. But with rising inflation and record high interest rates, securing an affordable home loan has never been more challenging. Traditionally, banks play a crucial societal role in providing mortgage credit to those who need it the most. Yet, many families today are being priced out of homeownership and struggling to achieve the American dream. Banks have been, or at least up until recently, ramping up disclosure of their environmental, social, and governance, or ESG practices, touting how socially responsible or environmentally friendly they are. An important question remains, are these disclosures reflective of real impactful actions, or are they just cheap talk? Take a look at the picture on the left. Here, we have a heat map of US counties based on their poverty rates. The redder the shades, the poorer the counties. What immediately stands out is a high concentration of relatively poorer counties in many southern states, as well as parts of the Midwest region. Let's now shift our focus to the map on the right. Here, we construct the average ESG ratings of all banks that provide mortgage loans in a county. We then plot out these ESG ratings across the country. Yellow counties are those where mortgage lending is done more by banks with supposedly higher ESG credentials. Compare and contrast these two maps, we see a distinctive reversal of the color patterns. Contrary to what many might expect, mortgage lending in poorer counties is not done mostly by banks with higher ESG credentials. Rather, it is driven mostly by banks with lower ESG disclosures. There seems to be a strong disconnect between what banks say they do socially versus what they actually do. You may be wondering whether the pattern we're observing here is simply because high ESG banks do not have as many branches or offices in low-income areas as do their low ESG counterparts. In other words, it may not be because high ESG banks intentionally avoid lending in low-income areas. It's simply because they don't have the local presence or infrastructure to serve those communities. To address this concern, we dive deeper into a more granular geographical level, focusing on mortgage lending in census tracts within a county. Take Bucks County, Pennsylvania, for example. The map on the left, again, is a heat map of the poverty rates of all tracts within Bucks County. Tracts with redder shades are relatively poorer areas. The map on the right is the map of ESG ratings of all banks that lend in a particular tract. Once again, we see a distinctive reversal of the colors, indicating that even within the same county, where both high ESG banks and low ESG banks are supposedly active, high ESG banks concentrate their lending in most of the affluent areas, whereas it is the low ESG banks that are picking up the slack in low-income areas. And this reflects a much broader problem, pervasive across the country, including other areas such as Hudson County, New Jersey. Let's now talk about our main regression analysis. The dependent variable, or the variable on the left-hand side of our equation, is what we call mortgage share, which captures the amount of mortgage loans in a county that is driven by a particular bank. What we are interested in here is the interaction between ESG and county poverty. The coefficient is consistently negative and statistically significant, suggesting that as we go from rich counties to poorer counties, high ESG banks reduce their lending more sharply than low ESG banks. This evidence is consistent with our earlier visuals, highlighting again the disconnect between bank ESG disclosure and their real mortgage lending towards low-income families. What's more interesting, if we further break out the continuous county poverty rate variable into decile dummies, with each dummy representing a higher percentage or percentile of county poverty rates, we see that the relationship between bank ESG and mortgage lending is actually monotonic in relation to county poverty rates. That is, banks systematically and monotonically cut lending as poverty rates go up. Let's also examine severe hurricanes as another natural experiment in which access to mortgage credit becomes most pronounced for affected households. After a major storm, families need to raise financing to repair or rebuild their damaged properties. Yet, in many low-income disaster areas, many properties are either underinsured or lack flood insurance. So, homeowners have little choice but to seek out loans to continue to have a roof to live under. And there are some interesting dynamics at play here. Banks become more reluctant to lend because of the heightened credit risks associated with major disasters. But on the other hand, banks also have greater incentives to engage in social wash, trying to project an image of social support and community engagement. So here we adopt an event study framework, tracking banks' lending behavior from 3 years before to 3 years after a severe hurricane hits a county. The plot here suggests that compared to low ESG banks, high ESG banks drastically pull back from lending in low-income disaster areas after a major hurricane hits the county. What's more interesting, the retreat in lending by high ESG banks actually bottoms out in year 2 after the hurricane, but yet to rise back to the pre-storm level even after year 3, suggesting that the withdrawal of lending by ESG banks is quite long-lasting. In conclusion, we find that banks do not appear to walk their ESG talk. Social wash tends to disconnect disclosure from real actions, eroding ESG disclosures' reliability and credibility. And we think instead of outright eliminating ESG disclosures, a more effective approach might be to strengthen oversight through a combination of rigorous academic research, practitioner engagement, and market discipline. And thank you for your attention for my presentation.